Most traders don't lose because they can't read a chart. They lose because they don't wait for the right moment to act. Trading isn't about catching every move, it's about catching the right one. And that brings me to today's talk, entry trick to boost win rate. If you remember the previous video on how to catch big money moves early, this builds right on top of it. Because once you can spot where the big money is moving, the next question is, when do you get in without getting your fingers burned? Now, let me tell you something that took me years of hard lessons to learn. Every fool in Wall Street can see a rising stock, but very few can enter it without chasing. You see, the market doesn't pay you for seeing what everyone else sees. It pays you for acting when others hesitate and waiting when others rush. So, ask yourself, how often have you entered a trade just because the move looked strong? And how often did that same strength fade right after you got in? That's the market's old trick. It tempts you. It lets you see a sure thing, then snatches it away the moment you touch it. So, I developed what I call the entry trap filter. Before I ever take a trade, I ask one simple question: is the stock inviting me in, or is it testing me? When it's inviting you in, it gives you confirmation. But when it's testing you, it gives you excitement, and excitement is poison to good trading. Most traders can read a breakout. Few can tell the difference between a real breakout and a trap. The difference, my friend, lies in patience. When you see a breakout, don't buy that first bar of strength. Let it break, let it pull back, and then watch how it pulls back. Does it drift down lightly on low volume? Do buyers step in again before it loses half of its gain? That's your signal that the crowd is impatient, but the professionals are still holding. I always said, the tape tells the truth. The chart whispers it first. So, don't just read the price. Read the character of the price. When you can tell a healthy pullback from a weak one, you've learned the entry trick that separates the players from the gamblers. Now, think about this. Why do most people jump in early? Because they can't stand to see a train leave without them. They're afraid the move will run away. But markets never move in a straight line. They run, they rest. They shake out the crowd, and then they run again. If you wait for that rest, if you learn to recognize the market's breath, you can enter when risk is low and confidence is high. Doesn't that sound better than chasing shadows? You see, a good entry is not just about price, it's about positioning. You want to be the trader who steps in while others are stepping out. When the emotional money says, it's over. That's when the smart money begins to quietly accumulate again. Let's take an example. Say you're watching a stock that's been trending up steadily. You spot a clean breakout over resistance, and volume spikes. Everyone rushes in. But what happens next? Price stalls, pulls back, and the weak hands get nervous. They sell. That's when I start watching. If price holds above the old resistance level, if that ceiling now acts like a floor, that's the market's way of saying, I'm not done yet. That's when you can slip in quietly while everyone else is stepping back. Now, remember in the previous video we talked about identifying the footprints of institutional money, the early accumulation before the big move. Well, this principle is its natural twin. Once you spot those footprints, this entry trick helps you step with them, not after them. You're no longer reacting to price. You're aligning with power. But let's not fool ourselves. No trick works every time. You'll still take losses, and that's fine. The point isn't to avoid losses, it's to avoid bad ones. A smart entry means that when you're wrong, you lose small, and when you're right, you ride big. That's how win rates improve. Not by more signals, but by better discipline. Sometimes I'd watch a setup for days without touching it. The crowd would jump in, jump out, and complain about false breakouts. But to me, every false move was just information. Each fake out brought me closer to understanding what the market was really doing. Because the market always shows its hand, just not to the impatient. You want to hear something? The best traders I've ever known didn't make their money by trading more. They made it by waiting more. Waiting for that moment when price, volume, and sentiment all line up. They didn't rush to prove they were right. They waited until the market proved itself. Ask yourself, are you entering because the setup is ready or because you're ready? That's the difference between the amateur's entry and the professional's. A professional waits for confirmation, not comfort. He knows that trading is a game of odds, not emotions. And here's another thing. Your entry should make sense in the bigger picture. Don't take a short-term setup against a long-term trend and expect to win consistently. Align your entries with the tide, not the waves. It's like sailing. You can't change the wind, but you can position your sail. You see, when you enter right, you give yourself permission to sit tight, and that's where the real money is made, not in the entry itself, but in the holding. You can't ride a big move if you're always worried you entered wrong. That's why this trick matters. It gives you confidence to stay with the trade long enough to let your profits grow. Most traders think they need more signals. They don't. They need more clarity. The clearer your entry, the calmer your mind, and a calm trader always beats an excited one. Now, I'll tell you something you won't hear from most trading gurus. Sometimes the best entry is no entry at all. If the market isn't giving you the setup you want, stay out. Cash is a position too. The market will always give another chance, but your capital won't come back if you waste it on impatience. So, the trick to boosting your win rate isn't a fancy indicator or secret formula. It's knowing when not to trade and when to strike with precision. And if you tie that with what we learned earlier about spotting, where the big players start their move, you'll find that timing suddenly feels less like guessing and more like reading. Because that's what trading really is, reading behavior. Reading fear, greed, hesitation, conviction. The price is just the reflection of those emotions, and your entry, that's your response to them. Most traders think that every price surge is an invitation to make money. They see a green candle, a sharp move, and they jump right in. But that's exactly where the market gets them. Because what looks like an invitation is often just a test. The difference between the two is what separates the professional from the hopeful. And if you can learn to tell them apart, you'll start entering trades with timing that feels almost uncanny. When I say an invitation, I mean a move that opens the door to participation. It's when the market confirms your bias, shows strength, and holds that strength in a way that welcomes new traders in. A test, on the other hand, is the market's way of shaking the tree to see who's patient and who's not. It's designed to tempt you into acting before the move is ready. One makes you money. The other takes it. Let me tell you something. Price doesn't move in straight lines for a reason. The market has to build pressure before it can release it. It needs to test the conviction of the crowd to see how many weak hands are still in the game. If too many traders are eager to buy too early, the market will often dip just enough to scare them out. That's the test, and most traders fail it because they confuse the test for an opportunity. You've probably seen it yourself. A stock starts to climb, breaks above a level everyone's watching, and volume spikes. Traders rush in hungry for the breakout, then suddenly price stalls. It drifts back under that breakout line. The same crowd that bought in excitement now sells in fear. The market does this again and again. It tempts, it traps, and it teaches. Only those who've been burned enough times start to recognize the difference. So how do you tell if it's a real invitation or just another test? Watch the behavior after the move, not just the move itself. A genuine invitation holds firm after the breakout. It doesn't collapse right back under the line. It consolidates, pauses, and then continues. Volume supports the move at the start, and even when price pulls back, that volume dries up instead of surging against you. That tells you the sellers are not aggressive. It's just the market catching its breath. But a test feels different. The move looks sharp, maybe even stronger at first glance, but the moment you buy, it loses life. The candles start shrinking, volume fades, and the market feels heavy. It's almost like walking into a room and sensing something's off. You can feel it in your gut if you're paying attention. The market gives off a tone of uncertainty, not conviction. And here's the tricky part. It's not just about reading charts, it's about reading psychology. The market is always trying to figure out who's committed, and who's emotional. A test is meant to shake out emotion. An invitation rewards patience. When you learn to hold back during the tests, you position yourself for the clean, confirmed moves that follow. That's where consistency lies. Have you ever wondered why big money rarely buys the first breakout? Because they know it's often a test. They wait for the pullback to show its hand. They let the emotional traders jump first, then collect the shares later at a better price. That's the difference between chasing and waiting. The small trader wants excitement. The professional wants certainty. The challenge is that the test move looks identical to the real one until you look deeper. Watch how the pullback behaves. Is it sharp and panicky, or controlled and shallow? Do candles close near their lows or hold near their highs? Every one of those details whispers the market's intent. It's not about predicting, it's about observing. You might be asking yourself, how long should I wait? The answer is simple: wait until the market proves it doesn't need your help. If a stock really wants to move, it will. You don't have to force it. An invitation doesn't beg for attention, it earns it through confirmation. The test demands reaction. Learn to deny that urge. That's where your edge begins. Let's think of it in emotional terms. A test move feels urgent. It stirs something inside you. Fear of missing out, the rush to act before it's too late. That's the market's bait. But an invitation feels calmer. It's not screaming at you to act. It's quietly offering you a seat at the table. When you reach that level of calm in your decision making, your win rate naturally improves because you're no longer trading from impulse. I used to think I needed to be in the market all the time. Every breakout felt like an opportunity. But over the years, I learned that most breakouts are just noise, tests to lure the impatient. The real opportunities, the invitations, come less often, but they're clearer. They move smoothly, without drama. The best trades I've ever had didn't feel rushed. They felt inevitable. There's something important to remember here. The test isn't your enemy. It's your teacher. It's showing you what happens when you act too soon. Each false start you experience is the market building your discipline muscle. Eventually, you stop flinching at the first sign of movement. You stop reacting and start waiting. That's when you begin to see the rhythm of price. When you look at it that way, trading becomes less about guessing and more about reading behavior. Every test, every shakeout, is a rehearsal for the next real invitation. And the beauty is, once you start to see it, you can't unsee it. You'll notice how often the market tempts the crowd before revealing the true move. So, when you sit in front of your charts and you see price breaking out, ask yourself, does this move feel like an invitation or a test? Are the professionals joining this move, or are they standing aside, waiting for the crowd to exhaust itself? The answer isn't in your indicators. Most traders can spot a pullback, but few know how to read what it really means. They see a price drop and instantly panic, assuming the move is over. But a smart trader knows a pullback is often just the market catching its breath before continuing higher. The trick lies in watching how the price pulls back, especially on volume. When a stock drifts down lightly, on low volume, it's telling you that sellers aren't serious. The big players are holding tight, and the move still has strength underneath. That's where the smart entry lies, quiet and almost invisible. You see, every trend has its rhythm. Price moves up, pauses, retraces, then resumes. It's never straight, never perfect. But inside that rhythm, there's information. A weak pullback after strength means the bulls are still in control. A heavy, high-volume pullback means the conviction is fading. If you can learn to tell one from the other, you'll know when to step in and when to stay out. Most traders don't wait long enough to find out which kind they're dealing with. They see the first sign of strength, they buy, and then the market takes a breath and shakes them out. Have you ever noticed how the market loves to test your patience? It's almost as if it wants to see if you truly believe in your setup. That's what a pullback does. It tests conviction. The professionals know this game well. They let the crowd buy the breakout, then they sit back and wait for the pullback. When volume dries up and price holds firm, they quietly start adding positions. Meanwhile, The emotional traders are exiting in fear, thinking they've made a mistake. The professionals buy what others sell, and that's how they consistently find low-risk entries. When you watch a chart, pay attention to the relationship between price and volume. Imagine you see a strong move up, clear, decisive, with heavy volume. That's the initial push. Then comes the pullback. If the price drifts down slowly and the bars on the volume histogram shrink, that's your clue. It means the sellers aren't aggressive. They're not pounding the stock. They're merely taking small profits. The market is resting, not reversing. That kind of action tells you the trend is still healthy. But if that pullback comes fast, on rising volume, that's a different story. It shows that the sellers are stepping in with conviction. In that case, you don't step in. You step aside. Let the dust settle. Let the chart show you stability before even thinking about entry. The beauty of low-volume pullbacks is that they give you a clean place to define your risk. You can enter near the end of the drift, place your stop just below the recent low, and if the trend resumes, your reward to risk ratio becomes excellent. I used to watch the tape for hours, waiting for these moments. They always looked boring compared to the dramatic spikes everyone else was chasing. But that's exactly why they worked. Real opportunities rarely look exciting. They look quiet, calm, even dull. That's when the market is preparing for another leg. The light volume drift is a sign of strength wearing a mask of weakness. Think back to what we discussed in the previous topic about telling an invitation from a test. This principle ties directly into that. The low volume pullback after a breakout is the invitation. It's the market confirming its intent. It's saying, I've tested the crowd, and the strong hands are still here. That's when you can enter with confidence. Not because you feel excited, but because the structure of the chart is on your side. Here's the thing, good entries are rarely about predicting the next candle. They're about understanding the context. A light, orderly pullback shows that demand is still present. If you see price respecting a support level, and volume drying up as it rests, that's institutional behavior. Those large players aren't dumping shares. They're holding, maybe even accumulating more. That's what you want to align with. Most beginners get this backward. They chase high volume moves because they think volume equals opportunity. But in reality, the best opportunities often come when volume fades. That's when the market has shaken out the noise and is ready to resume its trend. You don't want to be the trader buying at peak excitement. You want to be the one buying in the quiet before the next push. Think of it like breathing. The market inhales on big moves and exhales on small retracements. You want to enter during the exhale when pressure is low and potential is high. A light pullback gives you both, a calm entry and a clear structure to manage risk. And if you've studied the trend properly, you already know where the big money's direction lies. You're just waiting for your moment to step in without fighting the crowd. Have you ever wondered why seasoned traders look so calm while newer traders seem frantic? It's because the veterans have learned to love the slow parts. They know that a light volume pullback is a gift. It's the market's way of saying, relax, the story's still intact. So instead of rushing in during volatility, they wait for that moment of quiet confirmation. That's where consistency hides, in the silence between moves. Sometimes you'll watch a stock drift for days, and it'll feel like nothing's happening. But if that drift is happening with low volume, it's often the calm before a breakout. The professionals are absorbing supply while the amateurs get bored and walk away. Then, when the pressure builds enough, the next move starts, and it looks like it came out of nowhere, but it didn't. It was building quietly all along. This kind of patience isn't easy. It goes against human nature. We crave action, and the market knows it. It feeds off our impatience. But once you understand that a low volume pullback is not weakness but strength in disguise, you begin to shift your behavior. You stop reacting to every dip and start watching how it dips. You start seeing patterns in what others call randomness. And that's the heart of trading well, not just reacting to price but interpreting it. Every candle tells a story. Every volume bar is a clue. Together they reveal who's in control. When you see price drifting down lightly on low volume, that's not fear. That's control. That's structure. When a stock breaks out above resistance, that moment feels electric. Traders rush in, screens light up, volume spikes. It looks like confirmation. But the real story doesn't start until after that moment. What you want to see next is not more excitement, but calm strength. The true sign of a healthy breakout is when the old resistance level becomes the new support. That single shift in behavior tells you that market psychology has flipped. Sellers who once defended that level are now gone, and buyers have taken control of the field. It's one of the most reliable confirmations you can ever get. You see, every resistance level represents memory. It's the point where people got stuck before. It's where the last rally failed, and traders told themselves, if it ever gets back here, I'll sell and get out. That's why resistance exists, because of regret. But when price finally breaks above that level and then holds above it, something powerful happens. Those same traders who sold in frustration now start thinking, maybe I shouldn't have sold. That shift creates demand. The emotional tide turns, and what used to be a ceiling becomes a floor. The mistake most traders make is thinking the breakout itself is the green light. It's not. The breakout is the test. The retest is the green light. When price comes back down to touch that former resistance level, that's your chance to see if the market truly means it. Does price bounce? Does volume stay low on the pullback? Do buyers step in quietly but firmly? If the answer is yes, that's your signal. That's where the professionals often make their move. When the noise has faded, and the market shows it's ready for the next leg. Ask yourself, how many times have you seen a stock break out and then collapse right back under the line? It happens constantly because most breakouts are fueled by emotion, not conviction. The first wave of buyers is usually made up of traders chasing momentum. They pile in because it feels like something is happening. But the professionals wait. They know that real moves don't fear retests. If the breakout is legitimate, it will hold firm when price comes back down. That's the market's way of saying, I've turned this level into support. I'm ready to move higher. When I studied charts years ago, I noticed this pattern repeating across all markets, stocks, commodities, currencies. The behavior never changes because human nature doesn't change. People always react the same way to fear, to excitement, to regret. When you can see that transformation happening on the chart, you're not just reading numbers. You're reading emotion. The level that once represented hesitation now represents confidence. It's important to remember that this process doesn't always happen instantly. Sometimes after a breakout, the price will hover above the old resistance for days or even weeks, testing the conviction of buyers. Impatient traders get frustrated and leave. But the patient ones watch the volume, watch the price behavior, and wait for that gentle lift-off. When it happens, it often looks almost effortless. No rush, no spike, just steady demand pushing price higher. That's the signature of a level that has truly flipped from resistance to support. Here's a way to think about it. The first breakout is the spark, but the successful retest is the foundation. Without that foundation, the move doesn't last. Every big trend you've ever seen was built on layers of old resistance turning into new support. That's how markets build structure. That's how conviction is formed. When you enter a trade during that retest, you're aligning yourself with the psychology of strength, not emotion. In my own trading days, I used to make the same mistake everyone makes. I'd buy the breakout. It looked strong, it felt strong, and I didn't want to miss it. But more often than not, the market would pull back right after I bought, and I'd be sitting on red. Over time, I learned to wait. I learned that the retest, not the breakout, was the smart man's entry. Because if the market truly wants to go higher, it will prove it by holding that level. You don't have to guess, you just have to observe. Now, look at it from the other side. If price fails to hold above that former resistance and slips back below, that's not a signal to panic, it's information. It means the breakout was premature. The sellers are still strong, and the crowd jumped too early. You can use that failure to your advantage by avoiding the trap, Because every failed breakout saves you from unnecessary losses and teaches you to recognize strength versus noise. When old resistance turns into support, it's also an ideal place to define your risk. Your stop loss has a logical home, just below that newly confirmed support. If the level holds, your trade gains traction. If it breaks, you're out quickly with minimal loss. That's what professional trading is about. Controlled risk, not perfect predictions. You're not trying to be right every time. You're trying to be positioned correctly when you are right. This pattern also ties into the broader rhythm of market structure. Every higher high and higher low in an uptrend is essentially a series of resistance levels turning into support. That's how trends sustain themselves. Each breakout builds on the last, creating a staircase of confidence. When you start seeing this, you stop chasing the top and start waiting for the stair to form beneath your feet. Have you ever noticed how certain stocks seem to respect their breakout levels almost perfectly? It's not magic, it's behavior. Those are the stocks being guided by strong hands, institutions, funds, and disciplined traders who understand this exact principle. They don't care about the excitement of the first move. They care about the reaction to the pullback. They buy strength confirmed by control. When you can identify that moment, when resistance has flipped, you're no longer reacting to emotion, you're aligning with order. It's one of the most reliable signals of market maturity. You're seeing a shift not just in price, but in belief. And in trading, belief is what drives everything. Every tick on the chart is a reflection of conviction or doubt. When that old ceiling turns into a floor, conviction has won. So next time you're studying a chart, don't be distracted by the breakout itself. Wait for the market to show you that the level now has strength beneath it. Watch how it behaves when it pulls back. Observe whether buyers defend the level naturally, without struggle or panic. Every trader loves to talk about taking action, but very few talk about the power of doing nothing. Protecting your capital by skipping uncertain setups is one of the hardest lessons to learn in this business. It sounds simple, almost boring, but it's the foundation of longevity in trading. Most traders think that being active equals being productive. They believe that if they're not in a trade, they're missing opportunities. But the truth is, the best traders spend more time waiting than acting. They guard their capital like a soldier guards ammunition. Because in this game, survival is everything. You see, the market is a master of deception. It will always present setups that look almost right, nearly perfect, just convincing enough to tempt you. Those almost setups are where traders lose the most money. They're the ones that drain your patience, not because they're big losers, but because they chip away at your discipline. One trade that doesn't fit your plan can spiral into a series of emotional decisions, and before you know it, you're no longer trading the market. You're trading your frustration. Ask yourself, how many times have you taken a trade just because you were bored, or because you didn't want to miss out on what looked like a move? How many times did that trade turn into a small, unnecessary loss that didn't even need to happen? That's the tax impatience charges every trader who hasn't learned restraint. Protecting your capital isn't just about stop losses or money management. It starts before you even enter a trade. It's about saying no when something doesn't feel aligned with your criteria. The funny thing is, doing nothing feels wrong to most traders. It feels like wasted time. But that's only because they confuse motion with progress. The best trades don't come every day. They appear when conditions align, when price, volume, and sentiment tell a consistent story. Until that moment arrives, your money belongs in your account, not on the line. Cash is a position, a strong one. It's the most flexible position you can have because it allows you to act when everyone else is trapped. I've seen it countless times. Traders blow up accounts not because they didn't know how to trade, but because they couldn't stay still. They kept poking at the market, trying to make something happen. But the market doesn't reward effort, it rewards precision. The more you trade out of boredom, the more you dull your edge. Every mediocre trade you take steals focus from the perfect setup that's just around the corner. Protecting capital is about patience, but it's also about clarity. You must know what your perfect setup looks like, so that when something doesn't fit, you can confidently pass. Sometimes protecting capital means missing trades that actually work. That's part of the game. You'll watch something move without you, and it'll sting. But you have to remind yourself, it's not about catching every move. It's about catching the right ones under the right conditions. The discipline to let something go is what separates the consistent trader from the impulsive one. You don't need to trade to prove your skill. You prove it by choosing when not to trade. There's a phrase I used to tell myself, no position is better than a bad position. It's simple, but it kept me grounded. Every time I felt tempted to take an uncertain setup, I'd remind myself that being flat means I'm safe, flexible, and ready. The market isn't going anywhere. There will always be another opportunity, but your capital, once you lose it, takes time and effort to rebuild. And in that rebuilding process, most traders lose more than money. They lose confidence. Think about it like a sniper, not a soldier in a firefight. The sniper waits for the perfect shot.